Hello, and welcome to Fidelity Connects. I'm Lauren Gardy. Global stock markets have experienced significant volatility in 2025. April's downturn, triggered by U.S. tariffs, have since rebounded, with emerging markets, European equities, and U.S. tech giants leading the global recovery story. Factor investing can help strengthen a portfolio during various stages of the cyclical market cycle. Looking ahead, investors are curious. What is the current market landscape as we wrap up Q2, and which factors are poised to benefit from the current environment? Is it time to be defensive, or is there more room to grow? We last spoke to today's guest right before the tariff whirlwind. Is there more to the tariff story to come? Here to answer these questions and more is Bobby Barnes, Fidelity Head of Quantitative Index Solutions. Welcome, Bobby.
Hi, it's good to be here.
Great. So last time, as I was saying, we had you on Connects was in March, right before we saw the sell-off happen in April. And you were mentioning you were a little cautious on momentum going forward and perhaps favoring quality as a factor. Why don't you walk us through what we've seen happening with factors so far this year through volatility and where we stand today?
Well, yes, Lauren, it seems like an eternity since we last got together, and so much has transpired. And so I guess we recap at the end of last year, quality and momentum had done very well. There were narratives in the market that we all know very well, which is, the leadership of Mag 7, U.S. exceptionalism, K-shaped recovery, and the narrow market. And so at the start of the year, my expectation was that a lot of these themes would be persistent into 2025. As you mentioned, we got together a quarter ago and things were looking a bit shaky. And at the time, I was nervous about momentum in particular because it was, a lot of those names were tech related, and with the potential of a tariff war, I was really thinking that, the external countries, if they wanted to really retaliate against the U.S., that they would target our tech companies. And so, you saw from stock prices of the momentum names, they ended up being a source of funds to really fuel the outperformance of everything else. And so as we kind of went from some of the tariff announcements, initial announcements in the March timeframe into early April, momentum names were being sold off. And pretty much every other thing was working, whether it be factors, so value, quality, low vol, high dividend, small size. Similarly, the U.S., which had been outperforming for a long time, began to underperform the rest of the world. And you saw very strong performance from developed international or emerging markets. But as you said at the opening of this call, however, the market bottomed in early April, call it April 8th or 9th, I believe. And interestingly, what I've observed is that all of those trends have reversed. And so momentum has rebounded and recovered. It's actually up year to date. And a lot of those other areas that had done so well, be it, all the other factors, and even and then regionally the other regions, they've been giving a lot of that performance back. And so I think that makes for a very interesting backdrop as we, sit here almost, 6 months into the year and coming up with a forecast for the rest of the year.
That's fantastic. Thank you, Bobby. And your crystal ball seemed to be very clear last time you were on Connects. I did want to ask you what you see going forward now. What factors are you primarily focusing on for the rest of the year?
Yes, great question. And so the other thing that happened since we last met was we actually had an earnings cycle. And I think that was, really helpful in ascertaining where the impact's really going to be and how do we project things forward. And I think that that's actually attributable to that outperformance of momentum that I mentioned since the bottom of the market, where as a lot of those companies, as they reported their earnings, actually did quite well. And in terms of revisions, which is what really drives stock prices over time, the revisions for momentum were quite good, and hence drove the rebound and recovery in those names that we've experienced since April until now. Sitting where I am now, kind of incorporating that and other things, looking forward, where I was nervous on momentum before, I think it's really starting to crystallize that those names are going to be much more resilient throughout the rest of the year. So I'm actually back to having confidence in those names along with quality, which I've been long the entire time. Um, you know, the big question where we are now is, and maybe it's not as much as a question, but it's starting to really crystallize that uh, consumers are going to have to pay something. Tariffs are here to stay. It's just a matter of what level. 3 months ago, and I think a lot of market participants were wondering whether or not tariffs were just a negotiating tool that would ultimately lead to free trade or no tariffs. I think it's crystallized now that they are actually a key part of this administration's initiatives and actually going to be, I guess, a source of funds to fuel other things they want to do. And so the bank shots from that then is like, okay, prices are going to go up. And it's going to have an impact in purchasing power. And so I think that's going to, from a factor perspective, those more economically sensitive factors, and so small size is the biggest expression of that. It's going to be a headwind for those sorts of factors. And for the things that have been working, momentum and quality, I think those are likely to continue to look to the work moving forward. And then the last thing I would say is that low vol is kind of the sneaky outsider where I think there could be potential tailwinds for that as we get into the second half of the year, depending on how quickly margins and et cetera unwind due to the increased cost inputs for companies.
Mm-hmm. Thank you for that, Bobby, and for highlighting tariffs specifically, as that has been a very timely topic this year. Also, as we look over the next month or so, we are thinking about earnings. Last time you were on Connects, you were thinking very positively about earnings growth predictions. How do you view that going forward? Do you still feel as optimistic?
Yes. So earnings, several things to say there. So um, earnings are still coming in strong, but I am seeing differences across market cap. And so if we're talking about the largest companies, say the S&P 500, revisions are coming down, but we're still forecasting positive earnings growth throughout the rest of the year. Um, I was just looking at this yesterday, however, if we go down to say mid caps, what I'm seeing there is that the rate of decline in the earnings revisions is actually quite fast. So much so that if they continue along their current trajectory, we could see an earnings recession in the mid caps. And then similar story with small caps. And so we're not quite seeing that in the large caps, which would I think all put together, since the market is mostly weighted towards large cap, you would avoid an earnings recession overall for the overall market, but there would be potentially pockets based off of the earnings declines that I'm seeing as you go down in cap. And a lot of that, just going back to the tariff discussion, this administration is suggesting to a lot of companies that they want them to quote unquote eat the tariffs as opposed to passing along those costs to the consumers. And so to the extent that they do that, that's going to drive that margins compression and earnings contraction in those more economically sensitive companies.
Mm-hmm. All very good points. Let's bring valuation into the conversation as well. We've seen some semiconductors, notably NVIDIA, correct down to, if you could call it, more reasonable valuations. How do you see this impacting factors? Is that negative for momentum, positive for value? We'd love to hear your thoughts.
So that's another good one. And the valuation discussion is interesting in that we at the top level of the market, we've actually fully round tripped. So I think year to date, we're directionally positive in the S&P. Based off of that recovery that we've had. But the Mag 7, and you mentioned NVIDIA and those names, several of those, I think actually most of those are actually still down year to date. And so that's causing them to be less expensive than they were coming into the year. That is on balance, a good thing for those names. But the bigger issue I see with those names, however, is that their earnings revisions have actually been down. And what a lot of people don't fully appreciate is that the revisions in the Mag 7 is what drove their exceptionalism and outperformance in 2024 and in 2023. And so any factor that is overweight those names, to the extent that they have not experience that same revisions outperformance that they did in the past, that could be a headwind to those factors. And so specifically, that would speak to momentum, which is still overweight the Max 7. But there are a lot of other names in the momentum basket. And so for that reason, I'm actually not negative on momentum as a factor. Similar thing with quality. A lot of those Max 7 names are high quality, but the quality basket has been quite resilient throughout the whole year. And so I think that the valuation won't be a headwind to those baskets, even though by and large they trade more at a premium to the marketplace.
That's great, thank you. So let's revisit small caps again. You mentioned it earlier in the call. I did want to ask you your thoughts on this factor and if there is still an opportunity within this area of the market going forward.
Yeah, so small caps is an area where there was a lot of enthusiasm coming into the start of this year because the prevailing narrative was that we had nailed the soft landing. We're going to get all these rate cuts, which was going to reduce the cost of capital for small caps, and it was going to be a great kumbaya moment for those names. Fast forward to today, that's a lot has changed. Number one, we haven't gotten a lot of those rate cuts that were anticipated at the beginning of the year. But as we've talked about, and I hate to keep going back to tariffs, but that was a net new exogenous thing for those names to absorb. And small caps those companies have the lowest margins. And, to the extent that they're going to be expected to, it's almost a lose-lose environment right now, because if they're expected to eat the tariffs, that's going to reduce their already thin margins and reduce profitability, which won't be good for those names. But if they, instead of doing that, pass them through, a lot of their consumers are price sensitive. And so you're going to end up with lower demand. And so in my perspective, if I put all these things together, I have a hard time coming up with a bullish case for small caps, given these factors and where we are. And the last point I would make is that there's also the economic cycle portion of this, which we haven't touched on. We've been in late cycle, in my view, for many years now and continue to profile as late cycle. And so even if you have a constructive view on the market as a whole, which I actually do, when you're in late cycle, that tends not to be fertile ground for smaller, less profitable companies.
That makes sense. And we've seen that reflected in the small cap index so far this year as well. So lots of uncertainty. Is there anything, in your opinion, Bobby, that markets are not pricing in currently that they should be considering?
Well, the thing that I think is, from what I'm seeing, that doesn't seem to be fully priced in, and I think it's mostly because it's hard to price it in, is what rate will companies ultimately have to pay? Between that and then just the continued uncertainty where you have corporate directors who want to invest for the future, but they don't yet know if I need to spend $100 million on PP, plant, property, and equipment. And if I can place it here, I can place it, in this country or that country, and what the economics will be until we get certainty around that. That's going to cause those directors to sit on their hands. And I think that the market doesn't fully appreciate yet the downstream implications of corporate directors sitting on their hands on their investment planning. Because keep in mind, one company's investment is another company's revenue. And so I think that as we continue to traverse into the second half of this year, that's where we're going to really see the implications on both fronts, whether it be the increased costs that consumers are ultimately paying, or simply just the slowing down of business activity, because you've got these corporate directors that are sitting on their hands on the investments.
And we can't forget to talk about the bond market. What is it telling us with persistent rising yields?
So the bond market, I think there's a lot going on with the bond market right now. There's, on the one hand, you've got I guess the narrative that I'm hearing is that with the potential budget busting that this administration is going to take on with the spending that they want to spend, the deficit spending, they're saying that typical bond buyers are objecting to that deficit spending, and that's what's driving the bond rates to go up. But that having been said, I actually do think that there is still a good chance that we will get some rate cuts towards the back half of this year. But the key question, though, is the why. Like, why are we getting the cuts? Because again, echoing back to the comment I made at the start, there was anticipation at the beginning of this year of rate cuts, but it was the narrative was that was going to be policy normalization, right? Because we had increased the rates to combat inflation. We won. And so we were simply going to normalize policy. That narrative, I think, is completely gone away now. And so I think if you, to the extent that we get rate cuts, it's going to be in response to slowing growth, which, again, has its own investment implications that are associated with it.
Mm-hmm. Thank you for that insight, Bobby. Lots to consider. But let's shift gears, Bobby, in a direction of ETF flows. Within the Canadian marketplace, both in the industry and at Fidelity, we've seen tremendous flows going into international equity. I'm curious to hear your thoughts on the factor breakdown within this area of the market.
Sure, yeah. So interestingly, what I'm seeing internationally is, I spoke earlier about some of the weakness that we experienced with momentum here in the U.S. Internationally, that wasn't the case. Momentum was the best performing factor year to date in developed international EFA, and then also in the Canadian equity market. But I have seen a bit of unexpected behavior in that, as I talk about value being more of the pro-cyclical factors, where it does well when the economy is expanding. What you saw was that with the back and forth between the U.S. and other countries and the tariffs and the like, particularly in EFA, it provided an impulse for those companies to invest in themselves. And so as a result, that caused the value factor to do quite well. But really, it's almost like, especially in EFA, I think everything that I'm looking at on my dashboard is doing well year to date, whether it's value, momentum, which I mentioned is best, has done the best, quality, and even high dividend. I think they're all uniformly up in developed international. The one thing that with respect to international, that gives me a little bit of pause is that, year to date, it is the case that international markets have outperformed the U.S. And I think that too is attributable to the increased spending that each of those countries have committed to in response to the U.S. kind of pulling back on multiple fronts. When I look at the earnings revisions for the broader international market, I did see a corresponding initial upward impulse in the earnings revisions for the international regions. What gives me pause, however, is now that we've gotten through Q1 earnings, I think that we might have gotten a little bit of ahead of ourselves in the earnings expectations for international markets, and I'm actually seeing revisions to the downside, albeit short. It's only I've only seen a tick down over the course of the last, say, 20 days. But if that's going to resume, then I think that might give investors pause in terms of selling the U.S. allocation in order to buy the international market, with thinking that that the short-term trend should be extrapolated forward.
Mm-hmm. It's a very good point, Bobby. I will jump in and share as well for advisors on the call who might have current allocations to international equities, whether it be through passive or looking to add. Please reach out to your Fidelity wholesalers about the Fidelity International All Equity ETF, which combines 4 of the best performing Fidelity factors managed by Bobby's team into a one-ticket solution. And now let's move on to another area where we've seen strong flows, and a factor that's worked exceedingly well is the Fidelity US Value ETF. What can you tell us about the success behind this area of the market?
Yeah, so value factor is in a very interesting area right now. So candidly, a lot of what I said in terms of my outlook moving forward isn't as constructive for value, with my favorite overweights right now being quality and momentum. But the thing that's on my radar that I'm finding very attractive with our value factor is that what a lot of people don't know is that when a factor itself is cheap relative to its own history, that on average, that tends to be a tailwind to performance. Now, to be clear, valuation in and of itself is not causal. Like, things don't outperform just because they're cheap. You need to be cheap and have an earnings catalyst along with it. And so what I'm seeing with our value factor is that it's actually cheaper today than than it's ever been. And so depending on your horizon, that could be a tailwind. The other thing that's interesting and is a bit more nuanced with the value factor is that we do take mild sector overweights as a way of boosting the valuation exposure. And as a result of that overweight, utilities is kind of known as being a slow growth, boring sector and cheap. And so not surprisingly, we're overweight that sector as we typically are. But secularly, as we all know, AI demand where AI as a theme has gotten a lot of prominence lately. And for that theme, there's going to be a lot of demand for power. And so I think that between, those subtle nuances and the fact that the value factor ends up being a very good diversifier to, those investors that are concerned about the top heaviness of US large cap, I think those are two very salient points for considering an allocation to the value factor.
Mm-hmm. Thank you for that. So today's current market environment is a little bit different where we have such high concentration in the top 7 companies. I'm curious how low volatility fits in and compares with value in the US markets. We typically see low volatility outperforming during late, but you alluded that value has been working during that time as well. So why don't you walk us through that comparison?
Sure, yeah. And so the tricky thing about low vol is that it really, shines and does what it's supposed to do in a down market. And so that's what makes it hard to be really prescriptive in, make an allocation to low vol because you're really betting on the market going down. Otherwise, it doesn't participate as much usually as, some other factors would. But the other paradigm I would give you is that it's almost like house insurance too, though. The whole reason that you have home insurance is not because you expect that, making those payments, monthly or whatever the case may be, it's going to be a positive net present value investment, but rather that, again, it's an insurance policy and in the worst case event, it actually pays out and provides some ballast to your financial net worth. And so I think there's a case to be made similarly here where, echoing again back to what I said about my thoughts on US large cap and not necessarily seeing the prospects for an earnings contraction in that space, I think it might still be worthwhile having a little bit of low vol allocation for the insurance policy in the outside case of, okay, things, business activity slowing more quickly than what's currently being forecasted. And so that's, you asked me to compare and contrast with value. With value, it's, you get the diversification benefits that I mentioned earlier to the extent that the Mag 7 underperforms or doesn't, or just simply doesn't outperform as much as they did in the past. I think with value, you'll get more up market participation than you would actually get with a low vol allocation. So that's how I think about the tie break between the two of those, whether or not you want more upside participation or diversification benefits, which would be a tailwind for value, or if you want to take kind of the insurance paradigm that I mentioned and say, okay, well, I don't know exactly what's going to happen over the next, say, call it 12 to 18 months. And so maybe it's worthwhile having a little bit of insurance in the way of low vol.
Very well put. Thank you for that. I'd like to continue with this market cycle conversation, but going back to Canada really, and asking your thoughts on future rate cuts in Canada, given that the US and Eurozone will likely be cutting later this year.
Yeah, so I mean, I think that globally, what you're seeing is rate cuts. I mean, the U.S. has been slow to do so, but other regions, have actually continued to cut. And so I think that there's certainly a chance for that in Canada as well. I mean, obviously, Canada as being one of the biggest trading partners for the U.S. We still don't have a deal between our two countries, yet we are certainly tied to the hip economically. And so I think that if we look at just this week's and last week's announcements where the tariff rate on steel, for example, went up yet again, and steel actually does go across each of our borders several times before it makes its way into things like automotive. That's not going to be really good for either side. And so in order to offset the decline in business activity due to that, I think, Canada will certainly would likely use rate cuts as a tool to help soften that blow. Same thing as in the U.S., as I mentioned, the transition from policy normalization to actually, using monetary policy as a way to soften the blow of slowing economic activity. I think, you can really, likely see rate cuts in both regions.
Mm-hmm. Thank you for sharing that insight. And going back to market cycles, we were discussing how various factors typically align with where we are in the market cycle. But throughout this year, just so much uncertainty and volatility continues. What would your advice be if it's unclear where we are in the market cycle?
Sure. Yeah. So, there's always, the first thing to keep in mind is you always have to pick your sandbox and to answer the following question, which is, what kind of investor are you? And what I mean by that is, what's your investment philosophy? What's your approach? And let that be your guiding principle. And so, I've talked a lot about, my forecast for the future, what types of stocks via factors are likely to do well. But if that doesn't align with your overarching approach, it could be difficult to kind of stay the course, when that's needed. And you can kind of see that year to date, where I came into the year prescriptive on quality and momentum, and there have been so many market gyrations that if you were a bit skittish, the worst thing I think you can do right now in this market is change your, full sales, change your approach to investing, because you can get what we call whipsaw, where momentum, for example, worked in January into February, didn't work in March, but then recovered in April and May. And so that's the first thing I would say. But then, and maybe we'll touch on this as well. I think when I look at our product suite, and we've got, the all-in-ones that you referenced earlier, in the international market, for example, one of the beauties of that is that of a solution of that type is it handles the allocation for you. We keep it very simple. We allocate to, those factors that have been found to outperform over time, and then rebalance it accordingly. And so you don't need per se to be tactical if being tactical in your factor allocation isn't within your wheelhouse.
Mm-hmm. Thank you for that. And I'll take a moment to mention as well, Bobby referenced the all-in-one equity suite. We also do have a Fidelity all-in-one ETF multi-asset class, which we have added 2 new portfolios to that suite this week. That's the Fidelity all-in-one fixed income and the Fidelity all-in-one conservative income ETF. So Bobby, we really appreciate the discussion today. Are there any final thoughts to leave our audience with?
Yeah. I mean, I would close by saying, yes, things are turbulent, but again, echoing back to the comment I made earlier, whatever you do in your investment approach, stay the course. I think that's going to be lead to the better outcomes as we continue to get more clarity into the back half of this year and into the beginning of the next year.
Mm-hmm. Well, Bobby Barnes, thank you so much for joining us today on Fidelity Connects. Always a great discussion, and enjoy the rest of your day.
Thank you. Thanks for having me.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.